Welcome back to Furry Faced Finance, the show where we help young adults get a vision of what their future financial security can be. I'm JR.
And I'm Michael. And if you want to catch some of our previous episodes, we're going to drop a link to our YouTube channel in the show notes. So you can go and check all that out. Today, we're going to be talking about low risk investing, or as close to low risk investing as we can.
Right. I think to begin with, we really need to define what kind of risks there are in investing, because sometimes, we hear these buzzwords about investing, and risk is one of them. And I think sometimes it's hard to understand, well, what's risky about investing? I invest my money, I get interest back, right? Well, there is risk involved. And so when we talk about minimizing risk, we're talking about investing your money in stuff that has a pretty good chance of getting you the return that you've been promised. So, like, for instance, if Michael were an entrepreneur and looking for $100 to start his new business, maybe I'm an investor and I have $100 that I want to invest, and I want to get a return on my investment. I want to get 10% back. So, in essence, what I want to do is I want to hand Michael $100, and I want him to hand me back $110 once his business has gotten rolling. That's kind of the investment process. That's kind of the interest process. Now, here's where the risk can come into play. Perhaps Michael is a brand new entrepreneur, has never started a business before, has never been to business school, and he wants me to invest $100 so he can get his business started. Well, the fact that he has no track record for starting up a new business means that he's a bit risky. And that's not bad, but I may tell Michael, well, I expect to get more than a 10% return on my investment. If I'm going to take a chance that you might lose all my $100, then I'm going to say I'm going to want $125 back if it goes. That's kind of a risky investment. Now, let's say that Michael is a seasoned entrepreneur and he has started 15 businesses, and each of them has been great and they're flourishing. Well, now we're talking less risk. That does two things for my investment. One, I have a greater chance of getting my $100 back plus interest. And two, I don't have the opportunity, as much of the opportunity, to tell Michael I want $125 back, because he's going to say, well, I'll just find somebody who will do it for 10% return. So that's kind of the idea behind risk. It's basically about, the money you're investing, what are your chances of getting that money back, right?
Yeah, for sure. And I think you hit the nail on the head. That was a great example, JR, of, just keep an eye out for that. If you are on the wanting to do the investment train, definitely keep an eye on that and keep that in mind. I'm sure, as an entrepreneur, I would be telling JR stuff like, oh, but I had a very successful lemonade when I was 7. Trying to reach out and tell him anything that I think he would want to hear in order to get that investment. But yes, that is definitely a risk. There's no such thing as a no risk at all. No. So, that's just something to keep in mind, is no matter how much of a sure thing, there's not a guarantee that you're going to get your money back. So definitely only invest what you feel comfortable investing and what you would be willing to part ways with if for some reason there was a failure that came up that you had invested in.
And there are people that are willing to take that kind of risk. It's definitely something you want to talk over with a financial planner, though, before doing so. And of course, on our channel, we really promote at the minimum 10% invested in something that's safe and stable. If you want to pay yourself 30% rather than 10%, and you want to take that extra 20% and go to a financial planner and talk over how you might invest it in more risky things that will get you a greater return, that's fine. But we really think it's best for everyone to have 10% that they pay themselves, and that 10% invested in something that is very low risk, so that if everything else kind of goes to pot, that you'll have that chunk of money when retirement comes around.
So yes, with the 10% that JR was talking about that we're wanting to keep as low risk as possible, if you're in the workforce, you're probably already well aware, or if you're not, you want to talk to your HR person, because you actually do have access to the 401k. And a lot of companies nowadays, in order to keep competitive with the job market and make sure the most talented employees stay with them, do a company match. I know at one of my previous employer, it was up to a 6% match that I could put in there, and they would go ahead and match that in there. So I think that would be a great way to invest your 10% that we're talking about wanting to hold on to. If you're not and you're in college, go ahead and contact a financial advisor or financial planner. The compounding interest will still pay off in the end, and most of them will let you roll over into an employer account once you get into a full-time position. I do know that much. I know from personal experience that due to the company match and everything, I was actually able to relocate once I found a new position. I contacted Citi for the financial advisors. I'm going to have to pay some taxes on it, so be aware of that. Got some taxes, 20% withheld, and then potentially another 10% at tax time due to not being the 59 and a half years old to withdraw. But it is an option. So that's something else to consider. Not an ideal emergency backup plan, but I'm playing for the long run, so I'm not so worried about it.
Right. Yeah. And that company match, you've got to think of that in terms of free money. It's free money. It's you holding out a stack of cash in one hand saying, I want to invest this in my 401k, and the company saying, put out your other hand. We'll fill it up with the same amount of money and put it in there as well. So it's free money. You're basically getting 100% return on your money right there for that first 6%. So, and like there are several employers out there that will just invest in your 401k a certain amount, even if you're not investing in it. So you at least want to look up your 401k and see what's going on with that thing.
Yeah, I think that's a great point. Keep an eye out for it. I mean, especially as we're talking and we're wanting to eliminate as much risk as possible and play for the long run. That's definitely something you want to stay on top of is your 401k. I know that my previous employer would actually send out, I think it was either quarterly or multiple times a year of like a summary of, hey, this is how much you're looking at potentially having by the time you retire. This is how much you can pull out, kind of thing, which I thought was super helpful. And it gives you just a little bit. And then they also give you a phone number you can call to find that out. And nobody's going to look down on you for calling and asking. Everybody's going to be like pretty like, oh, that's cool. They care about their future. That's what we're shooting for. It is cool to care about your future. Keep that in mind.
Yeah, and even above and beyond the paper reports that they send quarterly, most of them have a website that you can log into. You can log directly into your 401k. Most of the time you can input some numbers and it'll spit out, like if you were to increase your investing, how much more you would have at age 65. Many of them will allow you to even reduce risk even more. When I worked up in Wisconsin at the factory with that 401k program, I didn't have a lot of control, but I could move my 401k investment from 80% stocks to 80% bonds. And we can talk in a future episode about what that means for reducing risk. But in general, bonds are a lower risk, lower reward than stocks. So what I did with my 401k at that point was I was invested 80% in stocks and 20% in bonds to try and generate as much income as I could, or as much investment income as I could during that time frame. But then 9/11 happened and the market started to crash. And I was able to get into my 401k and move my investment to 80% bonds and only 20% in stocks, which is an even less risky position. And because of that, when the market crashed, most of the employees around me were losing 10, 11% on their portfolio, their 401k, and I was still making 3%. Now, 3% isn't a lot, and we'll talk in a future episode about how the rate of inflation is 4% and how that impacts investing. But still, 3% is better than losing 12%. So take a look at your 401k, play around on the website, and try and understand how that thing works, because you can really do a great job of minimizing risk even more when the country itself is undergoing a recession.
And I think that comes back to kind of the thoughts of playing for the long run and covering your nest egg, because you want to be up to date and you want to be knowledgeable, because knowledge equals money. I mean, whether you're using that knowledge to do a career, or if you're just taking the money that you've already earned and making it work for you. That's a great example that JR just used right there, of making sure you're aware of what's going on in your country and making sure that you're kind of staying ahead of the game, because you don't want to get caught not knowing and money's just disappearing and you could have done something about it. Because I mean, that's a 14% swing right there at the low end, with him gaining 3% and losing, or versus losing 11. I mean, that's 14%. That's huge.
Mm-hmm. Yeah. Hey, if you guys have any questions about this, definitely DM us on Instagram or Snapchat. We'll answer your questions as best we can, because we want you to succeed.
We believe in you guys. Take care. Thank you so much for watching. Have a great weekend.